On behalf of the Bombay Chamber of Commerce and Industry, it's my pleasure to welcome you to today's post-budget analysis webinar. Thank you for joining us. Industry leaders, policymakers, professionals, entrepreneurs, and members of the business community. At a time when the union budget sets direction for India's next phase of growth. The union budget is more than an annual financial statement. It is a reflection of national priorities, an instrument of economic momentum, and a roadmap of how India intends to balance growth, inclusion, competitiveness, and fiscal responsibility. And that is why a post-budget conversation like today's is so important to interpret what has been announced, assess its real impact, and understand what it means for business, jobs, investment, and consumer confidence. This year's budget carries several notable signals that deserve attention. Among the key highlights are a strong infrastructure push with a record capital expenditure allocation of 12.2 lakh crores, reinforcing the government's commitment to building long-term productive capacity. Continued emphasis on manufacturing and MSME growth aimed at strengthening domestic value chains, improving productivity, and supporting employment generation. A focus on connectivity, urban development, supporting better logistics, mobility, and ease of doing business across regions. A clear intent to promote investment-led growth supported by policy reforms and targeted incentives. Sustained attention to strategic sectors, including a significant defense allocation of around 7.8 lakh crores, highlighting national security and indigenous capacity building. For industry and investors, these measures signal opportunity, but they also raise important questions. How will the budget momentum translate into faster execution on the ground? What will this budget mean for cost structures, demand recovery, exports, and credit availability? And most important, how can businesses align their strategies with these emerging priorities? Today's webinar is designed to discuss these pertinent issues. We are fortunate to have an excellent panel of experts who will decode the budget's provisions, assess sectoral implications, and share expert insights on what businesses should prepare for in the months ahead. At the Bombay Chamber, our focus is to ensure our members are not only informed but empowered to act with clarity, confidence, and stronger planning. For over a century, we have served as a trusted bridge between government and industry, advancing ease of doing business, innovation, and sustainable growth. Over the years, the Chamber has remained committed to fostering a culture of technology, innovation, and enterprise, while serving as a strong bridge between the business community, regulatory bodies, to name a few, and the government to support the ease of doing business. We have also consistently advocated for sound financial framework that enable growth which is sustainable, equitable, and inclusive. Our membership represents a diverse and dynamic mix of MSMEs and large enterprises across sectors. Members benefit from privileged access to policy advocacy, industry insights, specialized committees, training programs, and exclusive networking platforms that connect leaders across business, finance, government, and the academia. By joining the Chamber, members not only gain the advantage of collaboration and knowledge sharing, but also contribute to shaping the collective voice of industry, supporting India's economic progress. As a trusted bridge between government and industry, our committees organize over 100 knowledge-driven sessions annually, covering topics that are most relevant to our members and the wider business community. The Chamber is also recognized for its member-centric services, including issuance of certificates of origin, visa recommendation letters, and the provision of arbitration, mediation, and conciliation services. Guided by our enduring mission to support enterprises, empower professionals, and contribute to national progress, the Bombay Chamber continues to serve as a trusted institution and an influential voice of industry. We now look forward to hearing from our distinguished panel of economists and industry leaders who will analyze and discuss the union budget through the lens of its broader economic impact. I'm sure all of you are eager to hear from our experts. With that, I now hand over the proceedings to our panel to discuss Union Budget 2026, the economic perspective. Thank you, and thank you for being here.
Thank you so much, sir. We now move into our panel discussion on post-budget analysis and economic perspective. Before we begin, I request attendees to please share their questions in the chat box. Our experts will address them during the Q&A session. With that, let's introduce our moderator for the session, Dr. Sachchidanand Shukla, Chair EPR&D Committee, Bombay Chamber, and Group Chief Economist, L&T, and our panelist, Mr. Navneet Munot, Director, Bombay Chamber, and MD and CEO, HDFC AMC, Mr. Madan Sabnavis, Chief Economist, Bank of Baroda, Mr. Rajan Raje, Director, Bombay Chamber, and Founder and CEO, NICHEM Solution, Ms. Dipti Deshpande, Principal Economist, CRISIL, and Ms. Rajeshri Sabnavis, Director, Bombay Chamber, and Senior Advisor Tax, GT Bharat LLP. Over to you, Dr. Shukla.
Thank you, Priya. Thank you, Bombay Chamber. Good afternoon and welcome everyone to this post-budget webinar being hosted by the Bombay Chamber. It's not even been 5 weeks properly into 2026 and so many dramatic things have happened. As we speak today, I think today is the day, 5th February, wherein the START 2 agreement has ended today, right? Which means that this releases the two largest countries with nuclear arsenal, the US and Russia, from agreements that froze their nuclear missiles or arsenals, and it was limited to about 1,550, if I remember right, each. And this is the first time in the last 50 years at least that we don't have a binding limit on nuclear warheads for both of these nuclear powers. The other thing I want to highlight is, as we begin the year and this discussion, is that again, just 5 weeks into this year, and it is time to throw out most of the outlooks and year ahead reports that you got in your inbox. The world is now confronting a very, very different reality, one marked by a very, very aggressive US administration and change in Western world. A lot of people are calling this the new global disorder, right? If you look at India, there is another thing that's happened, and I don't know how many of you really make these New Year resolutions. Mine have died already in the first couple of weeks, but luckily the budget was one resolution that the finance minister actually forced us to keep, even if it was on a Sunday, right? All of us did come to our offices or our work and really look at the budget. So here we are with a fantastic panel, and each one of our experts doesn't really need any formal introduction, and it's already been shared by the chamber with you. So what we are going to do over the next 30 to 40 odd minutes is that we'll try and go to each one of our experts at least twice, and towards the end we'll have a rapid round, and then we open up the floor for Q&A. And you can also see that our panel is quite balanced, and we have two distinguished women experts. So why don't we start with Dipti, with you? So if I were to ask you, Dipti, what's the most important signal from the union budget on the government's intent and outlook going forward? Please use your rating agency hat and your economist hat to answer this.
Sure. Thank you, Dr. Shukla. Thank you, Bombay Chamber, for having me. And that was a great context that you gave to this discussion. I think similarly, so a context to what the budget had in mind is probably something I'd like to speak of. There were clearly two things that happened while probably the FM and her team sat to pen down this budget. One is the realization that the macro house has finally, been in order, has been brought into order. What do I mean by that is that growth is fairly sustainable. Inflation was at a record low when they started penning down the budget, perhaps. Fiscally, I'm sure we're all, proud to be part of a country where the debt as a percentage of GDP, the deficit as a percentage of GDP has been considerably brought down after the pandemic. Not very large economies, not many large economies globally are able to boast of such a feat. So I think fiscally also the correction is something that is worth speaking about. And from an external perspective, I think time and again we've all understood it's not the domestic vulnerabilities but the external shocks that have inflicted so much pain into our financial and currency markets over the last couple of months. So to reinstate, I think the macro house is in order, but it was also true that there were global shocks that were coming onto us. The reality and the acceptance that we have very little direct control into, like Dr. Shukla, you said, the new global disorder meant that we needed to look beyond all of this. So I think the budget priorities were threefold. Number one, how do you maintain the growth momentum? Second, how do you do so and at the same time ensure that we maintain fiscal discipline? Because globally, regardless of the situation, we are going to be seen from that lens. Our ability to, fiscally remain restrained. Plus, from our own perspective, how do we create that room in case there's another shock? The third thing that was important is that what do we do eventually to cushion ourselves from these trade and global shocks? So to me, I think the broad, global signal, rather the broad signal from this budget has been how do we navigate the stress by extending the runway? And largely how so? Number one, the momentum on capex has continued to be pretty strong. As a percentage of GDP, we're still doing pretty well. And secondly, I think the policies are now attuned such that we are now creating an enabling environment not just for one or two sectors, but we've diversified and we've decided that we need to now touch a lot of sectors at the same time. And to do that, we need to bring about an overarching change in reforms, be it process related reforms, be it structure related reforms, etc. So, one of the ways I thought of looking at this budget is why just look at budget 2026? Why not look at the last couple of budgets and see what is the narrative that's building up? What's the story that's building up? And what I realized that it's pretty clear. Once we were out of the pandemic staged recovery, there started a process where we began building infrastructure, huge capex thrust, building digitalization, pushing for innovation. We started talking about agri reforms after a really long time. As we went forth, there was dependence on implementation or absorption of some of this by introducing jobs and skilling related measures, so to speak. There were structural reforms. We introduced a lot on export competitiveness, manufacturing last year. And this year, I feel, like I said earlier, it's been diversification. We've tried to touch manufacturing through, the ECMS or the Semiconductor Mission 2.0. Our own research here suggests that just because of the ECMS, for instance, if we had value added component of electronics, especially mobile phone from India, at about 10% before PLI, post PLI, it was about 18%. After ECMS, it's expected to go to 35, and post this, semiconductor mission comes into force, it's expected to go up to 60%. So you're doing a lot of things now by ensuring you touch manufacturing. There is, cloud data service investments happening. So you're also touching services. So there is now, after the primary phase of, primarily focusing on infra build out, we are now trying to absorb the gains out of some of these. Two things, in my view, have remained constant throughout of the last couple of years. Number one, the capex allocation and creation thrust. Number two, ensuring that there's access to finance, ease and availability. And this time it's been enhanced by also bringing in, global players. So to some, I believe this budget articulates a strategy to navigate some of the exogenous shocks by extending the economic runway. Now, beyond this is rightly, like Mr. Rajiv Anand said, it's got a lot to do with execution. It's got to do with the continuous pursuit of this kind of a policy orientation.
Excellent. Dipti, that was a good overview of the macro, and you said macro is in order. Madan, coming to you, something wrong with the bond markets which reacted negatively? something wrong with the borrowing math? I mean, the gross versus net, and this whole thing, Madan, if you can, for this audience, if you can explain this whole move towards debt to GDP as against the fiscal deficit to GDP, which most people really have gotten used to. What are the options with the RBI as the debt manager? And can you please explain it in maybe non-economist language? And I know you explain this very well.
Okay, thanks, Sachin. Now let's come first to the borrowing program. See, the way I look at it is that the government, when drawing up the budget, decided on what would be the fiscal deficit ratio based on what was the revenue which could be generated based on the GDP growth projection which was made, which was fairly reasonable. So we come to a number of 4.3%. So therefore, we know that there is a certain amount of fiscal deficit. Now, how do we actually finance that? Now, to make sure that the market is not really spooked, I think the government started off by looking at what would be the net borrowing program. So we had a net borrowing program of that 11.7 lakh crores, which is analogous to what it was last year. So therefore, the market should not really have reacted because you have a number which is similar. Because we should remember that while the gross borrowing program is definitely something which captures headlines, but the net is actually what financial institutions and banks have actually subscribed to. So therefore, it should have been a status quo-like situation. To this, you add as to where is the balance money going to come from. So therefore, they decided that, okay, if we have a certain amount of fiscal deficit, we will dip into the small savings. And we'll also look at short-term borrowings, maybe some drawdown of cash balances. So that's how they came to this balancing of the fiscal deficit. Now, when we're talking of a net borrowing program of 11.7 lakh crores, the issue is that every year there are certain bonds which keep getting redeemed. This is the past debt which is taken by the government. This year it happens to be 5.5 lakh crores. So you add 5.5 to 11.7, it comes to this horrendous number of 17.2%. And since most of us, when we did our forecast before the budget, we assumed that the net borrowing program would be almost similar to what it was last year. I think somewhere we probably did not get this redemption number right. So therefore, the projections were normally in the region of around 15.5, 16 lakh crores. So when the number came to 17.2 lakh crores, obviously the budget got spooked, saying that, look, the market got spooked rather, saying that so much of borrowing is going to take place in the market. And that's one of the reasons as to why the bond yields actually went up. Was it rational? The answer is definitely not. Because whenever we look at what is the pressure on the market, it should be the net borrowing program, because this 5.5 lakh crores which is being redeemed goes to the same people who are actually investing in fresh government securities. So I think the market is probably going to correct. We should see the bond yields again go down to this region of around 6.6, 6.75, 6.65. Based on what happens tomorrow in the credit policy, what kind of language is used, because this is the way in which the market normally works. So to my mind, it was actually a non-event, but it became a big issue because we also had simultaneously the STT coming up. So people were looking at the market saying that something in the capital market has gone wrong, something's gone wrong with the bond market. So that was a kind of a panic reaction. But this, to my mind, is going to get corrected in course of time. Now, the issue about debt to GDP and fiscal deficit, again, to my mind, it is a non-issue. I think in the last 1 year or so, suddenly this issue has come up that should we be targeting a fiscal deficit ratio or should we be looking at a debt to GDP ratio? To my mind, it doesn't really matter, because while it's okay to say I'm targeting a fiscal debt to GDP ratio, which should come down to say 50% of GDP, the thing is that the only way I can do it is by controlling the fiscal deficit ratio. So I think we started off FRBM at 3%. Now we have realized that 3% is nowhere close to the mark. We are actually talking of 3.5%, 4%, 4.5%. Or whatever it is. So therefore, there is this debate, which again, to my mind, is quite unnecessary, because we will have to lower the fiscal deficit ratio continuously. And as we keep lowering the fiscal deficit ratio, we should also remember one thing, that my fiscal deficit in absolute numbers is also going to keep increasing as the GDP increases. So we're going to run into, and the redemptions in the next few years are actually going to increase. And I looked at some numbers by 2030, it's going to be 7 lakh crores of redemptions. So 7 lakh crores of redemptions means my gross borrowing program could possibly be crossing even 20 lakh crores. So I think that is what the issue is. So if suppose we have to put some kind of sense in this entire thing, I'll say, okay, the destination can be debt to GDP ratio, but the instrument which has to be used is the same fiscal deficit ratio. I need to bring it down to 3.5%, 3%. Only then will we be able to reach this number of 50%. Have I answered both the questions, or was there anything else, please?
Thank you, Madan. Yes, you did. Coming to Mr. Munot, how do you explain this? Madan talked about irrationality on the bond market side. On the equity market side, there was a negative reaction on the budget day, which was one of the worst on record for a budget day. Do you blame it on only the STT part, how the markets misread? And there has been a raft of news after the budget event. How do you see markets really absorbing the news flow from here on?
Sure. Thank you, Dr. Shukla. And it's a pleasure to be with such an excellent panel. So over the last, I think if you look at the last 15 budgets, I think that if the memory serves me right, on 10 occasions, market was negative on the day of the budget. And out of those 10 occasions, 8 out of those 10 times, market delivered positive return over the next 6 months or 12 months. So one should not read too much into the market reaction on the budget day, and there are like a lot of other factors at play. Several times, one or two headlines. This time, particularly the increase in the STT on F&O took a lot of limelight, and also maybe some of the other events around that time. So if you remember, that was a day of big meltdown in the metal stocks, but and of course the bullion prices, which may also have its implications. And talking about the STT, I think if it was DEA secretary or the minister made it clear that this is not about the revenue maximization. It's about should be read as the overall social or other objective of the government. When SEBI is saying that in the first report, 89% of the retail traders lose money. In the second report, they said that 93% of the retail traders lose money, and the money goes to few of the algo traders or the hedge funds, etc. I think one has to see in that context what government has done. Of course, I mean, there is another argument that the liquidity is important, and if it impacts liquidity in the market, then government needs to look at that aspect. But for me, I think the overall positives in the budget that you articulated, or what Rajiv mentioned earlier, or what Dipti said, or what Madan said, I think ultimately the fundamentals are a lot more important. Also, the another measure in the budget, which is very critical, that in last couple of years, when the corporate tax rate got reduced in 2019 to 25%, and there has been this whole period of deleveraging over the last several years, cash has got buzzed up in the corporate balance sheet. I think that we have a very limited capacity to take additional leverage in the household balance sheet. As Madan articulated very well, that government has a stated objective of bringing down the debt to GDP over the next several years. Then the balance sheet that really has to leverage is the corporate balance sheet. But for a variety of reasons, blame it on Chinese overcapacity, blame it on uncertain global environment, the capacity utilization hasn't reached a level where we are seeing a very large capex, and government has done every possible thing over the last couple of years, both on the supply side as well as boosting the demand, but we are not doing. So then we have to find a way to get that cash out of the corporate balance sheet. So cash is locked up in the corporate balance sheet, we have to find. And in that context, I think what has been done on the buyback taxation is very welcome. I think it'll lead to maybe some of the cash distribution from the balance sheet, and of course, I think will improve the overall capital allocation. I'm mindful of the time. Otherwise, a couple of more points. We'll see if we have time, then we'll discuss a few other things. But if you look at the Indian markets, in last 1 year, in my career over 30 years, I've never seen Indian markets underperforming to the magnitude we have underperformed in last 1 year or so. I think as of today, MSCI India would be plus 7% or so. MSCI US would be like 13%. Europe would be up, I think, 15% or so. MSCI World Index is up 20% YOY. China is up around 30%. In fact, till a few days back, but they're like big rally exactly a year back. So because of the base effect, they were up 40%. But if you see YOY, would be up 30%. MSCI EM index is like up 40% YOY. I've never seen India underperforming to the extent that it has underperformed. And within that, the mid and small caps have done even worse. Two things actually I would highlight. Actually, US has underperformed quite a bit. If you take the Max 7 out, then US has underperformed the rest of the world, and India has underperformed very significantly. Variety of reasons. One is, I think, the corporate, both I think economic growth and corporate profits have been lower than what the world was expecting. I'm talking about the nominal GDP growth and not the real GDP growth, and of course the corporate profitability. After like 3 good years of like 20% plus growth, last year was like a muted growth. I think all the measures that have been taken, and on this base, for next couple of years, corporate profit should grow at least in line with nominal GDP growth, if not a little more than that. And I think markets should deliver those returns. From a liquidity perspective, domestic institutions have been pumping in money. The SIP flows have been very robust, very stable. Now at the current run rate, last month was like 31,000 crores. If I look at the annual run rate of that, it's almost $40 billion. I mean, we have never seen foreign institutional investors investing that kind of money in any year. And if that continues, and I have no reason to believe that at least the SIP flows would continue at that pace. In fact, they are likely to grow. Then we are okay on the liquidity side. But of course, we need, as a capital deficient country, and from a BOP perspective, we also need the foreign flows. This year, I mean, while we had like one day on the day of the US-India trade announcement, we had large buying from the foreign investors, but I think we need that flow. We need those flows back. And this year, I feel that after a significant underperformance of Indian markets, and as the macro improves, both in terms of, as I said, the growth and the corporate profitability, I expect foreign investor flow also to turn positive, because on a relative basis, our premium to emerging markets has come down to a long-term average, in fact, slightly lower than that, and I expect foreign flows also to return. The only one thing that we need to keep in mind is that supply will also be very high. I mean, there has been last 2 or 3 years, a huge amount of primary supply to absorb the liquidity that's coming from domestic investors. As market picks up, at every level, you will also see supply coming in from private equity, venture capital, the other promoter selling, and of course, new capital raised by many of the companies. So that will keep the upside checked. But otherwise, I think this year, 2026, while the first few weeks have been extremely volatile. I mean, the only thing I can say about the global markets is that with certainty is continuity of uncertainty. We really don't know what will come on Truth Social tomorrow. But notwithstanding the Trump and tariffs and turbulence, I feel that 2026 is likely to be positive for Indian economy and Indian markets. Few other things, but in the interest of time, I take a pause here.
Thank you. That's quite a positive take and a well-rounded take on the market outlook. Moving on to Rajeshri, from a taxation perspective, do you think India is actually moving closer to simplicity and predictability, or are we adding new layers of complexity? Could you please walk us through your take on this?
Sure. Thanks, and a very good afternoon to everyone, and glad to be part of this esteemed panel. I think there are 2 or 3 things when it comes to tax. Tax is always a consequence or an implication of where economy and businesses go, right? We follow. That's one. Having said that, as Navneet just mentioned, saying that predictability of uncertainty is something which is certain. I think to that extent, I think tax, clearly this government, in fact, if you see over the past 2 or 3 years, they kind of trying to bring in a little bit more of reduction in compliance. When I say reduction in compliance, cost of compliance, to be very specific. Less of government, more of governance. Okay, that's something that they're trying to push. Third, to the extent possible, cut down on the litigation, although you will have spurts, because at the end of the day, tax, you cannot be getting away with structures which are absolutely, in the face of it is only purely for tax purposes. So you will still have those. And at the same time, there is recognition that we are part of a global value chain. So all in all, I think that's basically the theme. So if I were to explain this very quickly, when we talk about cutting down on existing businesses, there was a huge ask. There's too much of litigation that's getting piled up. Second, there is a lens that the government or the regulator or the tax authorities apply, which kind of says everything as penalty. So there is kind of some changes that have been introduced. So penalty now, to a large extent, will be termed as fee. So there are quite a few changes around that. The big positive, I would say, is if I were to look at the GCCs or the global centers, right? You do global centers of excellence. So there is a huge change which has been introduced in terms of the safe harbor rules. So what the government is really saying is, you have already set up businesses here. There are huge number of related party transactions. We will give you some certainty in terms of safe harbor, which was earlier around 17.5% or 18.5%. Now they've brought it down to 15.5%. So that's a huge leeway, right? So to a large extent, companies will get relief out there on that front. That's your existing businesses. Second, going forward, because, and this is why am I talking of GCCs and data centers, etc., because this is where we see that the economy is, moving forward in that direction. So what they're saying is, you enter into an advanced pricing agreement, we will give you certainty in terms of timelines within which each of these will be closed, because it's a long-standing ask of the business fraternity that this is taking a huge amount of time and there is absolutely no closure. So they're saying, no, we promise you closure. We will come up with measures to ensure that businesses have its predictability and certainty within a given period of time. Third, at the same time, they've also tried to cut down on some of the complications, i.e. we had something called as ICDS, which is very tax specific. So you had Ind AS, IFRS basically, which companies were supposed to follow. And for tax purposes, tax computations, we also had the ICDS. Now that, again, we as a chamber, in fact, we should be very happy, because as a chamber, some of our proposals, most of them in fact, have seen some discussion. There has been some discussion and probably acceptance in this current finance bill. One of this is this entire ICDS. It was also our request as a chamber saying that please do away with that, because it's only adding to the cost. And that's something which, if you see, they've done away with in the current year. At the same time, there's also discussion on, for the smaller taxpayers, there is a slight ease of, in terms of compliance, filing of returns. They brought in changes on, till what time you have. There is a period for which you can file your revised returns. Fourth, this entire issue of filing of Form 15G and 15H, especially for senior citizens and the individual taxpayers, with various institutions, they're now introducing it through the depository. Although it's still a year away, but that's again a huge step. So what they're really saying is, you just bring down the number of entities that you need to approach, just approach it to the depository. And I would say, clearly in terms of, so that was one of the themes. And I think pretty much, although there is certainty to some extent, predictability, again, you could. However, the moment you have changes in the economy and in the business value chain, business environment, tax authorities are not somebody who are going to just take it, as is. They will be questioning, because there are certain misses as well in this budget. And I think I will touch upon that, probably later, but this is what I had to share. Thank you.
Thank you. We all know that MSMEs are very, very critical for the growth and also creation of jobs in the country. We have with us Mr. Rajan, who's our expert on MSMEs. If I want to come to you, Mr. Rajan, what has the budget really done for MSMEs? And I mean, from a financing, liquidity, or even compliance perspective?
I think, as all of us know, MSME is always important for the Indian economy, Indian exports, sheerly because the lower overheads and better prices. But unfortunately, the MSME, if we look at the profile of the MSME in India, I mean, majority of them, I'm talking about below 25 crores or below 20 crore turnover per annum, they are still not very professionally operated. I mean, if you look at the knowledge of finance, knowledge of costing, knowledge of quality, knowledge of export or even marketing, HR. I mean, every aspect of the business still needs professionalism. Every time the government is been giving whatever is required, I mean, priority wise, if you look at it, I mean, first it was a financial support, CGT MSc schemes, or availability of the finance at a preferential rate, or telling the banks that, look, you have to be doing a priority lending to the MSME. But this time, what the government has done is they have decided to upskill the MSME, and for that they have tried to rope in the large organizations, and they have told them that please, the corporate Maitri concept, you start training them on every aspect of the business. In this process, you will achieve two things. One, you will upskill the MSME, they will become more professional, they will become more sustainable, and in that process, you will get credible suppliers. So it is going to be a win-win situation. And this whole scenario, I'm sure, is going to work very well, not only for the domestic market, but also for the export market. The other thing what the government has done is, every time they have been supporting the MSME in terms of finance by CGT MSc scheme or preferential lending, now they have opened up the trade system. So you can go on the trades and you can bid for your invoices, provided your buyer is also on the trades platform. In that case, it becomes a win-win situation. You will immediately get your payment, and it is going to be a bidding system. So with the bidding system, probably you will get a better rate. So the liquidity improvement is not only dependent on the banking system or the organized system. The trades platform is one thing. Even the NBFCs, the government has really encouraged the NBFC funding for the MSMEs. So overall, I think they have tried to discipline the MSME. They have tried to make them sustainable growth economy. So I think, yes, overall the MSME should benefit in long term, provided the MSME takes it in the right spirit and they takes it in the right perspective. I mean, I'm being a MSME myself, so I really know that how the discipline in doing the business is important. So personally, I'm very happy about what the government has initiated.
Thank you. Because we started a bit late, I think we have a paucity of time. What I'll request each one of you to, in this round, maybe keep your interventions a bit shorter, because we also need to go to the audience for Q&A. Quickly coming back to you, Mr. Munot, you did speak about the corporate balance sheets. I mean, it's been in the pink of health. But how do you see them really withstanding the global pressures, navigating the global pressures? And also, how do you see the markets in general? And some of the sectors, if you can walk us through, how do you see them navigating this entire geopolitical situation, conflicts, tariffs, deglobalization, and all of that? And more importantly, this Quit India movement that you spoke about by the FIIs, we haven't seen such outflows. Will that really stop, and will we see them coming back?
No, sure. So just to give you some number on the Quit India movement. So since 2021, domestic institutions like ours have put $250 billion in market. And in the same period, foreign portfolio investors have pulled out $20 billion. So their ownership has come down and our ownership has gone up in the market over the last couple of years. But keep one thing in mind, that for every buyer, there has to be a seller, right? So buyer has been domestic investor, the seller has been foreigners, and then of course, the primary supply. While you look at the numbers on the secondary market where foreign portfolio investors have been selling, interestingly, for a lot of IPOs, you see them participating as a very large investor. So it's not that, and you cannot put all the foreign portfolio investors in one bucket. There are different kinds of funds, and several of them are also taking a longer term view. I think, by the way, we talk about, you use the word, I was writing, the new global disorder. And I think Dipti also talked about something like that. But amidst all Trump and tariffs and turbulence and everything, you look at the global economy, there is a big investment cycle underway. And I used to write this 2-3 years back, driven by four very powerful forces. Number one is the defense. Because of this disorder, and you talked about the whole the nuclear pact ending between Russia and Europe, and the way US is turning more isolationist and more inward looking, the defense spending is going to go up everywhere in the world, whether it's Europe, whether it's India, whether it's China, whether it's like every part of the world. So that's like driving investment cycle. The second is the supply chain kind of realignment. Every country is looking at like producing locally, right? So we talk about Atmanirbhar, but every country is working on that. Be it rare earth, be it chips, be it like APIs, be it energy, be it food, be it fighting ability. So I call this 3F. Everybody has to produce locally, some part of it. Food, fighting ability, and fuel. Everybody looking at that security, which is driving investment cycle. The third is the energy security. I mean, I've already talked about that. And fourth is the AI spending. I mean, half of the US GDP growth has come from that, and every country will have to invest more, whether it's data centers and all that. Now, India, I think if we play our game right, and then in that context, like what we have done for those 7 frontier sectors, what we have done on some of the other measures, what we have done on custom duty this time, and some of the other measures, I think we not only plug into the global whole supply chain realignment, but also create a lot of security out of that, and that should lead to investments. And the tax holiday on data center can actually can attract a lot of investment, which again I think combined with the federal competition or the among the state governments and what they do can attract a lot of investments over a period of time. So I feel positive, while over the last couple of years that every possible thing that the government has done. Earlier, people used to say that they have more leverage. Leverage has reduced, and people said you need like all the supply side reforms. Many things have been done. Then on the demand stimulus, that has also been given, but some or the other excuse. Now it's like China overcapacity, the global uncertain environment, etc. But I think a tipping point is coming where we are going to see the corporate capex kind of like coming back. On the market side, as I mentioned, that valuations have corrected. I think you have 15-17 months of markets not delivering anything, so a part of time correction. While I mean you are seeing index only down, let's say 4-5% from the peak, and small cap index might be down some 10-11%, but there are a large number of stocks which are down 30-40-50%. The internals of the market, particularly the I call the tail enders, the small and mid caps, they are down quite a bit. So with this time correction and price correction, valuations are turning attractive, at least in a part of the market, and some of the sectors, whether it's like financials and consumer discretionary. In fact, parts of consumer staples are also turning attractive, telecom, some of the utilities. I think if we really believe in the investment and data centers, so there are like opportunities emerging that my fund managers are able to see.
Thank you. Again, going back to all our experts, I know I won't be able to do justice to your experience, but because we are short on time, what I'll request is maybe the questions that we have now, maybe a couple of sentences, and then we see how it goes. So quickly coming back to you, Rajeshri, what should be our tax agenda now? You can talk about direct or indirect, whichever, but essentially what we want to know is, are there sufficient and durable sources for India to be able to tap so that we are able to fund the India story, as we call it?
Sure, thanks. Very quickly, just two things, at least to start with. One is focus on the R&D spend by private sector. I think we are nowhere compared to what companies and corporate spend globally. I think there is some focus required there. And number two is essentially around the customs duty rationalization, because at the end of the day, value chain being a part, kind of being a part of the value chain, I think somewhere we just need to take a relook at the custom duty structure.
I'm glad you touched upon on the customs duty part. It remains an unfinished agenda. Coming back to you, Mr. Rajan, I think what I saw this time around was experts have been saying that for a change, the government was not administering oxygen to MSMEs and it provided them with some Horlicks, right? A lot of measures which you also touched upon. What else would you suggest? I mean, you did mention the corporate mitras and some of the other things. Is there anything else that needs to be done from your experience and expertise point of view?
I think I'll go with Rajashri. She quite clearly mentioned that innovation has to be given importance, and for which some impetus and some support from the government is required. Because without the innovation, whether it is MSME or large organizations cannot prosper and sustain. That is one thing. I also agree with her that the custom duty rationalization has to happen, because every time we go for FTAs, and if we are going to say that, look, our duties are not going to change, our sectors are going to be protected, and still you support us, that again is not going to happen. And the last thing is, see, what we actually need is a foreign direct investment, because that is the money which is going to be here. That is the money which is going to bring the technology, which is not going to be going away like FIIs. So if that happens, if the foreign direct investment comes, automatically the MSME is going to benefit with technology, is going to benefit because of the skill set what they will get, and it will be a sustainable growth. So that's my honest opinion.
Thank you. Madan, rupee has been behaving like a drunkard. I mean, we've seen, and also confusing a lot of experts, people. Till a few days back, I remember some people asking persistently, when will the rupee hit the 100 mark, right? And now people have changed the tune. I've seen some people really putting out their forecasts or reported in the newspapers, saying it is going, say, now back to the 85-90 corridor. What are the key things for all of us, for our viewers, if you want to speak about? I mean, what are the factors that we need to watch out for on the direction of the rupee?
Okay, so if we're looking in terms of what really drives the rupee, let's look at it. There are two sets of factors we need to look at. One are what we call fundamentals, and the second one would be the external or the extraneous factor. If I take the extraneous factor is actually what's happening to the dollar. So typically when the dollar keeps strengthening, all currencies weaken. And when the dollar weakens, all currencies start strengthening. So what we saw was that when the dollar was weakening, the rupee was still getting weaker. So we went in a different direction, but there was a reason for that. Now that goes to the fundamentals. Now, when you're looking at the fundamentals, we see what's the current account deficit. Now, notwithstanding the fact that we had the tariffs and export growth could potentially slow down, I think nobody is talking of the current account deficit going beyond 2% of GDP. We're actually talking of 1.5%, maybe the worst possible situation is 2%. So the problem is not really on the current account. So I think this is the first time where we have seen that the problem has actually been on the capital account. Now, capital account problem has been because we have seen minimal flows coming in as far as FDI is concerned. There have been more repatriations, there have been more outward foreign direct investment. So that is something which has kept FDI, which we normally took a thumb rule to say that $80 billion will come in. Today we're talking of in net terms, it's somewhere closer to $10 billion and not 80. The second part is, of course, the FPI. So I think that has been a major factor which has been driving the rupee. And why is it that the FPI has been moving out? As an economist, I feel that there has been an overvaluation of securities. I don't know if Navneet will agree with me or not, but definitely the PE ratios look over-exaggerated given the valuation. So therefore, there had to be a correction. Other markets seem to be doing much better than India. So maybe that's the reason why they were going to other markets rather than India. So if you look at Indian corporate profitability, I think it's been very anemic this year. Even the third quarter, we're talking of 7-8% growth in profits. It should have been much higher. But I think those 15-20% growth rate in profits, those days are over. We are coming to a single digit now. And then, of course, there was a lot of uncertainty concerning the deal. So I think that was supposed to be the kind of clinching factor, saying no deal with the US, and US saying that, that 50% tariff hanging. So I think that's the reason why I think foreign investors were a bit jerky, they were a bit shifty when it came to investing in India. And I think that's the reason why the rupee took a beating. So therefore, we saw at the moment that Donald Trump announced saying that the tariff rate is coming down. We still don't know what are the details of the deal. Okay, but still the very fact that we're saying that it's 18%, I think that itself has given a kind of a booster to the rupee started strengthening. So I feel that 89.91 would be a fair range for the Indian rupee. I don't think I ever went beyond 92, but yes, there were people who were talking of 95, even 100. But I think 89.91 would be a fair rate based on how our current account deficit will behave, and also in terms of a revival of FPI, especially in the equity segment.
Thanks for that rupee outlook. Coming to you, Dipti, and then one more thing, Madan, you said you don't know whether Navneet will agree with you or not. I don't know that, but certainly nobody seems to be disagreeing with our women experts. So going to you, coming back to you, Dipti, very quickly, if you could just tell us, in your judgment, is the budget more a capex oriented or a consumption oriented budget? Because this is a perennial debate that we have, and for the benefit of the people who joined us, if you can just very quickly tell us, what do you think of this?
Well, from an allocation perspective, I think purely from an allocation for this budget perspective, I would say it's a more capex driven budget than a consumption one. But it's also true that did we need a consumption boost at this moment from the center? Perhaps I think the answer would be no. For two things. One is that we did receive a boost in the last year, so we will get some of those benefits or those gains over the next couple of quarters. That's number one. Second is the fact that there is quite a bit of consumption related stimulus coming in from states. They are through their unconditional transfers. As we spoke, another state also announced it. So I think the need for this for the government to keep its, or the central government to keep its pressure on capex was perhaps what was required. So in simple numbers, if the total expenditure this year is about 7.7% higher, effective capex, that is when you add capex and the grants that create capex, is growing 22%. And if you see revenue expenditures after taking out these capex grants, it's growing by only 2%. So to directly answer your number in numerical terms, this is how the tilt essentially is. But before I end, I think the question in mind is that do we also need, or can we also afford this kind of capex growth every year? Because at the end of the day, it's also what kind of execution ability, cost overruns, etc., the government faces. After all, government capex investment is about 23% of total investment or total fixed asset investment in the country. So, to what extent can only one agent, apart from households, of course, keep driving capex is the story. So, if we, for instance, budgeted about a 10% growth in capex last year, we were able to bring in about 4%. So, the point is that capex needs to be driven, but perhaps policy efforts need to go beyond mere capex allocation to also conducive environment creation of an ecosystem, etc., which this budget essentially speaks of.
Thank you, Dipti, for settling that thing once and for all. It's a capex-oriented budget, as you said. Gayatri and Priya, if you can just let me know if we have questions from the panelists, because we are now going to have a rapid
yes,
round.
Sachin, if I can just make one point out here.
Sure,
when you're talking of capex, see, when we say the government is spending 12.2 lakh crores, it's also a case of saying that there are 2.2 lakh crores transfers to the state. That's the long-term loans they're giving. Similarly, when you're talking of capital grants, now see, very often we are mixing it up by adding it to the center, but even the states are going to show that they're spending capex on the basis of that 4 lakh crores. So a lot of double counting is actually going on. So we have to be cautious of this, because if suppose we were holding a conference on saying on state budgets, that 4.2 we were given credit to the state saying that they're 12 lakh crores plus 4, because they're actually spending that money. Here you're passing on certain things because that is based on what the Finance Commission says. So I think one should be very clear about it, because to my mind, center is only one particular part of it. We expect the center to do too much in terms of capex when actually it has to be done by the private sector. And the private sector, including L&T, will not invest unless you see opportunity. Because at the end of the day, you go back to your shareholders, you have to see ROC. So while everybody says, I want private sector investment, those guys are not going to invest unless there's a return. So for which you need demand conditions to improve. That's where the consumption part really comes into play.
Fair enough. I think that caveat was in order. And for all of us here, Madan's worked with a rating agency, he's worked with a bank, he's worked with a corporate. So he's got extensive experience as an economist, and thanks for that point. Priya, do we have some questions, or can we go in for the rapid fire round?
Yes, Dr. Shukla, we have received one question. So question is, what is the impact of the budget on the aviation sector?
Okay, why don't we do it this way? We'll wait for a couple of more questions. Let's finish this rapid fire round, and in the meanwhile, people can maybe think of some questions.
Yes.
So, Mr. Rajan, this is the rapid fire round. One word, one sentence, short sentence answers. What do you think is the impact of trade deals on MSMEs? What is it going to be?
Good one. I think it has definitely opened a new avenue, and it should be really encouraged. Only question is the larger organizations, they have to come on the trade platform. Otherwise, it doesn't work.
Thank you. Rajeshri, in terms of the tax assumptions, which one is more credible, the direct tax ones or the indirect tax revenue growth assumptions?
I would say the indirect tax ones. Indirect tax ones, definitely, because so they've kept, sorry, I'll just take 20 seconds, but the trade deal also requires implementation via notifications, etc. So that, to my mind, the way you had a GST 2.0 before the finance bill, you probably should see they have a better avenue of introducing notifications, etc. to actually make it work. So I would say indirect tax.
Thank you. Madan, you've already answered, you told us where do you see the rupee, where do you see rates this year? I mean, when I say rates, I mean both the RBI repo rate and also maybe the 10-year yield, if you can.
No, in fact, I think the repo rate cycle is over. 5.25 is where you're going to end. In fact, I was against the cut even last time, because historically we have had a repo rate in the region of 5.5% to 6%, given the fact that inflation historically is 4.5%, in fact, closer to 5%, real rate would actually be justified by a repo rate of 5.5%. But now that we're at 5.25, I think we'll remain at 5.25%. And I think when you're talking of bond yields, I think that's also kind of, it sort of vindicates the position that, look, the yields are not going to come down anytime soon. And the rate we are at maybe 6.7 can come down to 6.5, 6.6, but we won't really be going below that at 5.25%.
Dipti, what do you see India's growth rate as? And also, if you can maybe just to close this, the CPI, where do you see these numbers in F27? What are your numbers?
Well, we all know that my forecasts last for 15 days and 20 days. We'll have the new CPI and the new GDP series soon. But in any case, given the current numbers, we are expecting GDP growth for the next fiscal at 6.7. CPI inflation at 5%. The low base basically takes up the CPI inflation.
Now, the easiest of all questions, Mr. Munot, where will Sensex or Nifty be a year from now?
Oh, thank God you didn't ask tomorrow. I mean, even 1 year is not easy to predict. But in equity market, returns come from three sources. I mean, your earnings growth, your dividend yield, and change in P. I think the valuation re-rating is tough from where we are today. Dividend yield is very small in India, so returns will be driven over the next couple of years by the earnings growth that we have. And as I said, that our nominal GDP goes back to, let's say, 7 plus 4, maybe more like 11% over the next couple of years. And maybe if we can push the pedal a little higher, overall corporate India earnings growth should be in that line. Within that, there would be a few sectors that would do better, few sectors that would do lower than that. So market should deliver that return.
Thank you. Priya, can we go on to the questions now from the audience?
Yes, sir. Should I repeat the first question once again?
Yeah.
Yes, sir. So, what is the impact of the budget on the aviation sector?
I don't know who can really answer this or who wants to. Any takers? Yes.
Well, that's great.
Who's taking? Because
No, I don't know whether directly aviation, but I don't know what was there which directly impacts, but indirectly, there's a lot of focus on tourism. I think we see the number of words devoted to tourism in many ways that has been done, I think, which augurs well for the overall aviation sector. Yeah.
But then directly there is nothing which was given. As Mr. Munot said, yes, overall the tourism will give impetus to not only aviation, but also everything. I mean, all kind of transports. So it should be good.
Right, Priya, do we have?
Yeah, how well does the budget address the employment stagnation challenge, especially for youth and semi-skilled workers?
And please feel free from the panel to, or you may raise your hand and we can go to you. Anyone who wants to answer.
Madan here, if I could. Yeah, see, if you look at the way in which the government has spoken of the outlays, which you're talking of for MSME fund, which has been created, or even if you're talking in terms of infrastructure, you're talking of the freight corridors, new cities being built, I think all this will have implications for employment. And when you're talking, it will cover both skilled as well as semi-skilled labor, because a lot of construction work will be taking care of the semi-skilled labor. And when you're talking of things like data centers, anything to do with technology, we'll be looking at addressing the issues of skilled labor. So I think we look at employment more as an indirect kind of a result, positive outcome coming from what the government is doing in terms of its expenditure.
Thank you.
Do you have any other questions?
Yeah, with no change in personal income tax slab, do you see any missed opportunities to boost consumption or stimulate demand among the middle class?
So any of the two ladies can take this, and lady experts.
Well, if I can go further, I don't think there is a missed opportunity. Like I said earlier, a lot was announced even outside the budget last year, rather the GST rationalization, the income tax relief measures, all of that was primarily focused on benefiting the middle class and the lower middle income in some ways. But I think the bigger unasked for and not policy wise intended benefit that came by was a very sharp fall in inflation and food inflation. So that was clearly a benefit of last year. And I think all of that is allowing even the DBT, etc. I think all of that, there are consumption related support measures in place. So I do not look at it as a missed opportunity, so to speak. There were drivers, perhaps there was no need to have any more incremental drivers in this fiscal. Yeah, over to Dr.
Yeah, Madan wants to make a point. Yeah.
Yeah, see, working in a bank, and we have seen what kind of an issue banks have had in terms of garnering deposits. So I think one of the demands which were their demands or requests, however we put forward a petition rather, was that they need to give certain kind of benefits to interest earned on deposits. Because if you're looking at the future growth of Indian economy, the fact that most of the savings come through bank deposits and bank deposits are moving towards Navneet's market, we have definitely been handicapped in terms of raising deposits. So to bring about parity in terms of the interest, I think what we were asking for is essentially a case of saying that if you have 12.5% long-term capital gain, put a similar thing for interest which is on long-term deposits. And this is something which probably could not be taken on in this budget because of maybe the financial constraints which are there, because at the end of the day, you have to spend, it's only a limited amount of money which you can earn. But I'm sure this is something which will be taken on seriously, because if you look at bank deposits, they do a very important function from the point of view of government. 18% goes as SLR, which is financing the government's budget. Another large section, 40% of your lending goes to priority sectors, which are important for the government. So I think at some point of time, we do think that this will be taken up, and we will probably persist in making this kind of a request to the government.
Correct. So if we don't have any further questions, Priya, we can bring this to a close. Do we have
Yes,
any?
sir. Yes, sir. Thank you so much, experts, for an interactive and impactful discussion. Thank you, Dr. Shukla, for moderating so well.
Priya, just give me 1 second.
I'm so
My
sorry.
only KRA in this whole discussion panel discussion was to ensure that we start and finish on time. I couldn't do the former, but I'm glad that we are able to bring this to a close in time, just in time. Thank you, each one of the panelists. I mean, we actually could get the richness of their expertise and the depth of their expertise. Thank you so much once again to each one of you. Yeah, back to you, Priya.
Thank you.
Thank you, experts. Once again, thank you. Now I request Ms. Gayatri Vinayak, Assistant Director, Bombay Chamber, to please deliver the vote of thanks.
Good evening, esteemed guests, speakers, and our audience. On behalf of the Bombay Chamber of Commerce and Industry, it is my privilege to extend our heartfelt gratitude to each one of you for joining us online for the post-budget discussion, the economic perspectives, and a special thanks to our knowledge partner, Grant Thornton Bharat, for their support and for making this webinar truly enriching. My sincere thanks to Mr. Rajiv Anand, President, Bombay Chamber, and MD and CEO, IndusInd Bank, for welcoming the audience and sharing his valuable insights on the budget and the chamber. We're deeply grateful to all our speakers, our moderator, and panelists for their time and effort. Dr. Sachchidanand Shukla, Chair, EPR&D Committee, Bombay Chamber, and Group Chief Economist, L&D, for moderating the panel. Mr. Navneet Munot, Director, Bombay Chamber, and MD and CEO, HDFC AMC. Mr. Madan Sabnavis, Chief Economist, Bank of Baroda. Mr. Raje, Director, Bombay Chamber, and Founder and CEO, NICHEM Solutions. Ms. Dipti Deshpande, Principal Economist, CRISIL, and Ms. Rajeshri Sabnavis, Director, Bombay Chamber, and Senior Advisor at Grant Thornton Bharat LLP, for the engaging discussion on the economic perspective. My appreciation also to the Bombay Chamber team for bringing this webinar together. Thank you once again, everyone, for your presence and for the highly engaging discussion. And we look forward to your attendance and participation in all our future events. Thank you so much.
Thank you.
Thank you.
Thank you.
Thank you.